Is it possible to beat the market by a whopping 7% yearly? Can a retail investor with no background in stock research earn a 19% annualized return while taking lower risk than the market? In this video, I will present data that proves it's not only possible but practical. Join me while I do this 20-year backtest. We'll see all the outlier scenarios and learn how to handle them. There are some exceptions, so make it a point to watch the full video. In 1994, I made my first investment in a mutual fund. At that time, I didn't understand how it worked. The idea of making money in stocks and trading was as exciting to me then as it is today. During the launch, it was advertised as a rupees 300 crore fund with an allotment on a first come first served basis. In those days of poorly informed investors, this created a frenzy. People queued up outside the banks early in the morning to apply. And unfortunately, fund management was extremely poor, resulting in a 20% loss upon launch. There were no means of exiting or obtaining quality information. Once bitten, always paranoid. This experience served as my first lesson in risk management. In today's technique, cater to investors with limited time. You will either invest in the whole market represented by the Nifty 50 or choose an active mutual fund which has a history of outperforming the Nifty 50. We will use a combination of two traders indicators. Unlike traditional trading, a red indicates selling and a green indicator means buying. We're going to do the opposite in our investing methodology. This is based on betting on the growth of the Indian economy. There are caveats and exemptions which I will cover in this video. So make sure to watch the entire video and understand how wealth was compounded at 19% rate. Also, if you're interested in knowing a related method to invest in small cap to time buying and selling better, please watch this video. I'll provide the link in the description. We will navigate to the tradingview.com site and select Super Trend and Super Trend Strategy indicators. These indicators use ATR or average true range to signal trend changes. We enter 200-day value and a factor of 7. When the trend turns positive, traders typically invest, but we'll do the opposite. Buy when the indicator turns red and sell when it turns green. This is because in this strategy, we are going to take a contrarian stand. We go against the conventional investing psychology. The first red candle signals a bearish trend. The next day, marked by the second red candle, we buy. Upon the trend changing, the first green candle indicates a reversal and we sell the next day, that is the second green candle, resulting in an 8.5% profit in about 76 days. We record this trade in an Excel, which we will later use to calculate the long-term returns. Let's look at another example. This is an exception. Here, the entry and exit would have yielded a 3% return, and we say it is less than a threshold that we set for ourselves, which is 5%. So whenever the returns are less than 5%, we will wait until the next sell signal. Here again, the return is close to zero, so we ignore this turn and wait until the returns exceed 5%. In the next sell signal, we get 9.6% in 468 days. The return looks less impressive, but we take it and close the position. The next example, we skip the first sell signal as the returns are low 5%. We wait for the next sell signal, which comes after a wait of 530 days, which is close to 2 years, but we get a good 31% return. Let's record this. In the next example, we'll see a major crash and how to handle it. But before I do that, there's an interlude story that will help you appreciate the scenario better. A man walked on the rope. The crowd cheered for him. Eventually, he successfully crossed the rope to the other side, eliciting a sigh of relief from the audience. He then asked if they believed he could repeat this feat again, and everyone roared yes. He then challenged the audience, asking who would be willing to place their child on his hand as he walked the rope again. Suddenly, silence engulfed the audience. No one dared to take that risk. While they acknowledged his ability to walk and cross over, there was a lack of faith. This scenario mirrors a challenge in investing. We all possess the knowledge about the considerable potential for growth in developing country like India, but we often lack the faith to translate the knowledge into investment actions. Now let's explore the major crash scenario and how we will handle it. Here, after we get the buy signal, the market crashed. Our sell signal would have meant a 36% loss. So we hold on to it until the next sell signal. And this comes after 1171 days or 3+ years with a nominal profit of only 14%. But we take that. Now comes another exception. If the market experiences a very sharp correction of 25% after our initial purchase, we will initiate a second purchase at that level for a similar amount as the first one. This position we will exit along with the first position upon the next valid sell signal. This comes after 996 days and we make 54% return. Note, such a huge correction happens only once in a decade or so. If you track all the buy and sell signals over the past 20 years, just for a back test, you will have 20 such transactions. I have given an approximate transaction record here with the dates and the returns. If you now calculate the XIRR of these transactions, you will find that you have a return of 19%. This is just one indicator. You could choose from a variety of indicators, conduct their back test. This indicator is not the holy grail. It's more like a pole vault. It provides you a sense of direction. However, the return comes with faith and conviction and being able to act in a contrarian manner. This method may result in periods of sitting out of the market, leading to occasional missed opportunities. I'm not calculating the tax and transaction impact cost of these trades. This is a probabilistic science and not deterministic. The idea is to be directionally right than being diagonally opposite. In conclusion, our 20 years investing experiment mirrors the delicate balance of a tightrope walker. Success isn't just about knowledge, it's about faith in our strategy. Our contrarian approach requires trust and conviction in the face of market uncertainties. Thank you for watching this video. I've spent a lot of time to research and create this. So if you enjoyed this content, please consider liking this video. If you did not, please dislike it so I will get to know your feedback. Consider subscribing to this channel and sharing it with your friends.